How y'all doing? Hope everybody good. Wanted to drop in and give y'all a quick video. Today's video, I want to talk about how to get started in the stock market. Y'all know the theme on this channel, we learning together. As a beginner investor myself, just sharing the knowledge as far as what I've been learning so far and also where I've been learning. So different books, YouTube channels I like, different resources that have helped me make things a lot more understandable. A common theme I hear with people that haven't quite got started in the stock market that would like to start is that it's really confusing. So with this slideshow, trying to make it as not confusing as possible. So let's get into it. So why invest into the stock market? Obviously, we're trying to grow money and build wealth. And if you look historically, a lot of people have been able to do that for themselves and their families. Let's take the rule of 72, for example. So a lot of us have our money just sitting in the savings account or we have it in cash and it's not really doing anything. If anything, it's losing purchasing power to inflation. So with the rule of 72, it shows us how long would it take for our money to double depending on where it's at. So let's take a savings account for example. Usually with a savings account, they're not growing too much at all. But let's say if you have a savings account and it's growing at 1% annually. If I have 5,000 sitting in the savings account growing at 1% annually, how long would it take for that 5,000 to double to 10,000? And you would really send to it to show you. So you take 72 and you divide it by the annual growth rate. And in this case, it's 72 divided by 1% annually, and it gives you 72 years. So that's saying 5,000 sitting in the savings account growing at 1% with double to 10,000 in 72 years. That's a really, really long time compared to, let's look at the average return in the stock market of 10%. So I take 72, divide that by 10, and I got 7 years. So that's a lot faster. And then, like I said, the average return is 10%. It usually never hits 10. It's usually either above 10 or below 10, but it averages out to 10. And even when you factor in inflation, you're looking at around 7 to 8%. So that's really good because you want to have, so we want to start thinking, okay, how can we start putting our money into places where it's growing for us? And also start thinking about it from the perspective, how can we have our money in places where it's beating inflation? Because going back to our rule of five, our example of 5,000, if you had just 5,000 just sitting, 5 years from now, that 5,000 gonna buy even less. It's losing purchasing power because inflation is eating it up. So we want to start thinking, okay, where can I put my money in the places where it's protecting its purchasing power? And you could think a lot of us are feeling that now. If we look at 5 years ago, things were a little bit cheaper. Now they're a lot more expensive. So why is that? Because of inflation. So we got to start thinking like that. Another reason to get into the stock market is because the barrier to entry isn't too difficult. So when we're talking about OGs that have been investing forever, a lot of them will tell you like back then it was a lot harder. You had to have a certain amount of money. You had to go to this place. You had to call this da da da. Compared to now, you literally could just download the app on your phone. You go you download the app, the brokerage. You put your information in, link your bank account. You can invest from there, and you don't need a lot of money. So it's a lot easier now. Another reason is because we're a consumer of these companies. Let's turn into an investor with an investor of these companies. So, yeah, I remember us talking on Christmas. We spent $1 trillion on Christmas presents. We're gonna continue to get these companies riches. We might as well make a couple dollars with them. So, changing our mindset from consumer to investors. So we're already investing into these secondhand just as consumers. If you think about it. And then the earlier you start, the better. So a lot of us watching this video, 20s, 30s, early 40s, we got time on our hand. Let's take advantage of that time. And with that, you don't have to put this huge amount in. As long as we're being consistent, it could be $20 a week, or it could be $100 a month, $50 a month, whatever works for you. But when you just consistently been putting, you've been consistently investing over time, you're gonna see what it's doing for you. And that's when we're talking about compound interest, where our interest making interest and our money starts working for us. But to do that, to see that, it takes time and it takes patience. But when we understand that, we know how to move about it. We understand we got to be patient with this. And then another reason is because of liquidity. So when you think about assets like real estate, they're not as liquid as far as you can't get that money out when you need it. if you ever needed it. Obviously, investing in assets, we're not really trying to take this money out, but let's say we ever did need it. If you had a lot of your money tied in real estate and you needed that money soon, you can't get it compared to the stock market. You can get that money a lot faster. So it's a lot more liquid than as far as compared to real estate. Some terms to know. We got the stock market, a place where you can buy and sell shares of a publicly traded company. And think of like the movies or some of the pictures that you might see the news back in the days, like the 80s and stuff, where it was like on the trading floor. A lot of it is more digital now. And then you got a stock. So a stock is partial ownership in a publicly traded company. So think of it like a pie. You got a small slice of a pie, or you might have a big slice depending on how many shares you got. But take pride in that. You know what I'm saying? We take the ownership, equity, and we're referring to publicly traded companies. Okay, you might have Talit Fish Restaurant. That would be a private company that's owned by me. Then you got these companies that go public, where a lot of times where they sell a portion of their equity to people like me and you, to where we can invest in it. And a lot of times they do that, they want to raise money, or they might be trying to pay off debt, or various reasons. So you got different companies that we consume, or that we consume with any day. Now we got to become investors with them. So we're talking about Apple, got Microsoft, Google, McDonald's, Nike. You got all these companies that we participate in every day as consumers. So why not start investing in them? And then when you purchase a shares in the company, you're a shareholder of that company. And then say when you have shares and the price goes up, the value of your investment goes. When you have shares and the price go down, vice versa, the value will go down. And then you can also receive dividend payments depending on which companies you're investing in. So some of these companies, with their earnings, they will pay a portion of that to their shareholders. So they have it where just because you're investing to the company, they'll pay you for investing in them. And that's pretty cool. That's when that's really powerful. But keep in mind though, just because a company doesn't have a dividend, that doesn't necessarily mean a bad thing. So when you might have it where a company take their earnings, instead of paying it to their shareholders, they might just reinvest that back into research and development, or research, invest it back into the company. So don't look at it quite as a bad thing, but it's still powerful where you can get paid for literally owning the company. And then a lot of times when people refer to like, okay, the stock market went up today or the stock market went down, they're usually referring to indexes. So when we think about inflation, so when you have inflation up or inflation down, they're not usually referring to one product. They're usually referring to a basket of products. Same thing with the stock market. When they're saying the stock market went up today, the stock market went down, they're usually not referring to one company. They're usually referring to a group of companies. So we've got these different indexes like the S&P 500 and the Dow Jones Industrial as an example. So the S&P 500 would be 500 of the largest companies in America by market cap. And we're going to talk about that as well. And then we also had the SEC. So this is Securities and Exchange Commission. They protect investors and make sure everybody is playing fair game on the market. So they basically like the referee of the stock market. So remember in the end of the 1920s, we had the Great Depression. So with the Great Depression, a lot of people got burned by the market because there was a lot of companies just being pure like fraudulent, and they're being really shady. So they came up with the SEC in the 1930s to reinstore confidence in investors that people not, they're gonna protect people. And when you hear things like market manipulation and insider trading, that's when the SEC come in. Like they just trying to make sure everybody being fair. Like I said, they're sort of kind of like the referee of the stock market. Sometimes they gotta blow their whistle. And then how are they grouped? So with stocks, you have large cap, you have mid cap, and small cap. So we have market capitalization, and that's basically how many shares a company has multiplied by the current share price. So a lot of times when you might hear, okay, this is $1 trillion company, or this is, that's usually they're referring to their market cap. So let's say we're going back to Talit Fish Spot, and I'm a publicly traded company, and I have 10 shares of my company on the market, and the price of those is $10, the price per share is $10, my market cap would be $100. So when you hear Apple's a $1 trillion company, they're referring to the market capitalization being, a trillion plus. So you got large cap. These are companies that are over 10 billion in market capitalization. You got mid cap. These are companies that are between 2 billion and 10 billion, and then you got small cap. These are companies that are less than 2 billion, but they're larger than 300 million. So a large cap, these are more like your established companies. They ain't really got that much room to grow because they done already grew. Then you got mid cap, they got some room to grow, but they're not as volatile, they're not as new as a small cap. So this like they're in the middle. Then you got small cap. These have a whole lot of room to grow, and they're a lot more risky and volatile. But you have them grouped that way through, like I said, large cap, mid cap, and small cap. And then you also have them grouped as 11 sectors. So you got the financial sector, you got energy, you got healthcare, you got consumer staples, then you got a lot more as well. And then you also have where you got different kind of stocks. So you got growth stocks, you got your value stocks, you got your income stocks. So they be grouped all different types of ways. And then with investing, you want to have a long-term thinking. So when we talk about long-term investing into the stock market, this is a long-term investment vehicle. You invest with money you don't need in the short term. So when we're thinking about our goals, so we might have it where in a year or two, I might try to buy a car. That might be considered a short-term goal. I'm trying to have $1 million saved by retirement. That'll be my longer-term goals. When we're talking about, I would say with the stock market, don't put no money into the stock market as far as long-term investing that you don't need in a minimum of 5 years. The reason I say that is because in the short term, it's going to go up and down. But over the long term, you zoom out, historically, it's been going up. Now, past performance is not an indicator of future performance, but, I don't think it's the end yet. And so you don't want to put it where you put in money that you need in like a year or two in the stock market just to hope and pray that it's going up and then it goes down. Like I've seen stories where a person wants to buy a house within a year and they put their money in the stock market and the stock market go down and they panic and they mad. Now they ain't got no money for their house. You don't want to do that. So minimum 5 years, really 10, but 5 years at the minimum. You ain't trying to take that money out within 5 years. Corrections, pullbacks, crashes, they are going to happen. So as long as we know that, we're aware of that, we're gonna know how to react when they do happen. And you could look at when the market goes down or the company you're investing in goes down 30-40%, you could look at it as a buying opportunity potentially. I say potentially because if you're investing into a bad company and it goes down, it might not never come up. But when it's like the general market goes down, look at that as an opportunity because it's on discount. Think about when your favorite shoes are on discount. You're gonna pounce on those as a consumer. So we gotta start thinking the same thing with these assets, as an investor. And you have to train your brain to think long term. It's really easy when everything is going good. What about when your account drops 30%? So like I said, I'm a beginner investor myself, but just trying to learn the history and just, watching a lot of people that's been in the game for a long time, we have to be aware that the American stock market has been doing good for 20 years. The last crash we had was in like 08. Well, we had COVID and then we had last year, but it wasn't as bad, compared to some of the like 08 was the real deal crash. So I say that to say we might have recency bias for a person that's just getting started where they just see green and their account just keep going up and up and up, and then we can all say like there's gonna be another crash. So when there's a real deal crash and we in red, you might panic. You might not. You might look at that like, oh shoot, because you ain't never seen that before. You didn't study history. So we have to make sure we're thinking long term and we understanding that that's the nature of the beast. So when the next crash do come and your account is down 30-40%, you're not panicking. If anything, it's on discount. You know what I'm saying? You buy more. So we have to be aware that, especially for us that's just getting started. Like, don't be emotional when you see red and happy when you see green, because when you see red and it's real deal red and there's blood in the streets, there's opportunities for us to attack. There's opportunities for us to make generational wealth for our families. But if you didn't know, you gonna mess that opportunity up, and you're gonna sell. You gonna It's not a loss until you sell. You know what I'm saying? So making sure we're understanding what we're getting into, and we're studying history. Research. Hold, give me 1 second. And some research. Making sure we're learning. Make sure we're learning the basic terms. We went over a couple, but there's way more we gotta go over. Well, not in this video, but just make sure we're learning. And I'm gonna make sure at the end I show y'all some books that, like I said, make it a lot easier for me, and YouTube channels I like to watch. They like to basically speak it to me from like a basic level where I can actually understand. As I just talked, man, we gotta make sure we study history, like, and understanding different signs of things. Like, okay, we see what happens when there's a bubble. Eventually, got to pop. What caused the bubble? You to happen? Okay. What happens when the interest rates are? What happen? How does the market usually react when the interest rates are higher and things of that nature? So we got to just, and when things occur, it might not be exactly how it occurred back then, but it might be similar. Like, where, okay, we've seen this before, so we know how to react. And this is very powerful. We got to actually allow ourselves to learn. So I keep emphasizing this is a long-term investment vehicle. This is not a get-rich-quick play. If you're thinking get-rich-quick, you're not gonna digest the information, because the information is not gonna make sense to you. No, you're not gonna be rich. You're not gonna be rich tomorrow investing into the stock market long term. But over time, which time is gonna go by fast, as we always say, damn, but time going by fast. You're gonna build real wealth if you approach it the right way. So when we learn this information, actually digest it. Don't be, oh man, this ain't gonna, you know what I'm saying? Like, we gotta get out this get rich quick, this hustle mentality. We gotta start being builders. We gotta start understanding how can we plant seeds for trees years down the line. We ain't trying to, you know what I'm saying? Like, we're not gonna be rich tomorrow. And also watch out for information overload. So it might be, well, this person saying this person saying that, this person, and you gonna, oh man, what do I do? And then you're gonna be like, oh man, I ain't doing nothing. It's gonna, you know what I'm saying? So just take the information in, learn, and figuring out what works for you, but making sure we don't get information overload. I think we've all been there where it's just so much information, we don't want to do nothing. Now we ready to get our hands dirty, we ready to jump off in the water, we ready. But before starting, we need to make sure like we always talk about, make sure we have our base. So you want to have a starter emergency fund, at least 1,000 to 2,000 in savings. Reason being, well, an emergency fund is emergency savings. So a savings account you strictly have for emergencies, car breaking down, losing jobs, appliances going out, things of that nature. Kids sick, you gotta be out of work. Reason being, because it makes life easier. You know, it gives you peace of mind that, okay, when my car break down, I don't have to worry about maxing out my credit card even more, asking for family. You know, I could just handle that. But as far as investing to the stock market, remember when we start investing into these assets, we're not trying to take them out anytime soon. Remember, we're trying to keep it, whatever we're investing in on the market, at least a minimum of 5 years. So you don't put 1,000 into the stock market, but you don't have no emergency savings. Think about what you're gonna do when you need that money. So your car break down and you lose your job, you're gonna take that money right out the stock market. So making sure we were focusing on the base. Remember, you can't build a house from the top up. You gotta start with the base. You know, so start an emergency fund, and also that high interest debt need to be paid down as well. Remember, we gotta look at our whole financial picture. So you done got a 10% return in the stock market, but your credit card, the interest on your credit card 22%. So it's just, you sort of kind of, you still in the negative. So go ahead and get that high interest debt paid down. That's 100% return on your investment. So go ahead and handle that, and understand with building these things. We're talking about the emergency fund and the high interest debt. It's a long game. Remember, when we talking about wealth, we're not trying to be rich tomorrow. We're playing the long game. So let's go ahead and get on that. Also, when we talking about, I forgot what I was saying, being honest. Start an emergency fund, high interest debt paid down. And let's say, okay, even if you do start investing a little bit, just make sure you working on these things on the side, because I promise you in the end, it's gonna help you out a lot better. And then just figuring out what percentage of your money is going towards investment. So that's why we're making sure we're tracking our income and expenses. What percentage you going towards investments, so we still want to be, even once we get the starter emergency fund, we still want to be saving towards a full emergency fund. And after that, we still just want to save in general. Typically you want to have an emergency fund of 3 to 6 months, but past that, build you up to a year. Past that, build you up to 2 years, because all it's doing is giving you time. When you have a year's worth of expenses saved, you thinking different than when you have a month worth of expenses saved. You know what I'm saying? Time is our biggest asset. But what percentage of our money is going towards investment? So you might have it where you put in 10% of your, or you might have it where you putting 5% of your money towards investment, or 10%, figuring out what works for you, and also figuring out what kind of portfolio are you trying to get with when you talking about investing. So I'll show y'all some channels and book stuff at the end, but I like Whiteboard Finance. This dude named Marco. He has a really cool philosophy as far as like, are you gonna be a person that's all in stocks? Are you gonna be a person that's all in on real estate? You gonna be a person that's all in on Bitcoin, or are you gonna have a little bit of everything? You know what I'm saying? Where you diversified across assets. And the reason just a lot of people like that is because when one asset goes down, it's not the end of the world that you're not all in. When we talking about these crashes of like '08 and all that, you had people literally committing suicide because a lot of their money was tied up in that one asset. So figuring out what kind of investor are you, and this video about stock market. So what percentage are you putting towards stocks? So let's go ahead and get what we're doing. So now we got our retirement accounts, as far as like, how do we actually get started? What do we invest in? Where do we invest? So a lot of people like, a good place to start is with your retirement accounts. When we talking about 401k, your health savings account, your Roth IRA, depending on what kind of job, your 403b, traditional IRAs, things of that nature. We can do a whole video on the retirement accounts, but just trying to give y'all a quick synopsis. With your 401k, it's pretty cool because a lot of people I see with the 401k is a lot of people I see that have a 401k, they say the same thing. Boy, that money add up quick. For sure. Imagine if you put even more in there, you know what I'm saying? And it's a perfect example of pay yourself first. So for people that don't know, your 401k is a retirement savings plan that you can invest a portion of your paycheck into before taxes are deducted. And it's pre-tax money, so when you withdraw it in retirement, you'll be taxed. So with your 401k, you put a percentage up to you put a percentage of your paycheck. As soon as you get your paycheck, you already see it's took out your 401k. So that's pretty cool. And like I said, it's a real example of pay yourself first. With 2026, the most you can contribute to it is $24,500. Another powerful thing with the 401k is your employer can offer you a match. So that's where you get basically free money, and you know what I'm saying, you can't beat that. So they might offer you like a 6% match or a 3% match depending on your company. The only thing to think about with the match is what they call a vesting schedule. So you have to stay with the company for a certain amount of time to get the full match. So if you think about getting to, that's usually where a lot of people start as far as investing with your 401k. Talk to your employer about do they offer a match, and if they do, what's the vesting schedule with that as well? Because say if you do like the go from not just a job hop in a bad way, but like companies offer you better terms and you get more money with another company. Does your job, if you're investing in your 401k, does your job have a vesting schedule? Let's see. And like I said, this is a retirement account. So the most you can contribute per year, the most you can contribute this year is $24,500. It does rise with inflation. So next year you could contribute more. You can't withdraw the money till you're 59. If you do withdraw before then, you usually get a penalty. So when you think of with these retirement accounts, as far as like the 401k, think of it as like last resort money. Like this is money that was a super duper emergency. You don't want to be thinking of it like a savings account where the money is going in and out. This retirement money. So, and you don't gotta put no boku amount where to the point you can't contribute. It might be where you put 3% of your checking in. That's cool. With the 401k, typically you have limited investing options in there. usually we'll talk about those, but usually like various funds, like a target date fund, or you might have like something that tracks the S&P 500. So we'll definitely talk about that. Then after your 401k, we got the Roth IRA. So this is after tax dollars. When you take it out in retirement, it would be tax free. So with the Roth IRA, the most you can contribute in 2026 is 7,500. With the Roth IRA, this is what you open up with your brokerage account, which we'll talk about next. And you could choose what you want to invest in this one. This one you got way more investment options. Let me see. Oregon Star return accounts right there. Can't tell you. If you make more, I think it's like if you make more than 150,000, you can't contribute to a Roth IRA, but it's another method you could use for that. Then you got the health savings account. This is for health expenses, but it's triple tax. So, like I said, with these accounts, they're cool because they offer real tax advantages. It might not mean a lot right now for a person just getting started, but down the line when you've been investing 20, 30 years and you got hundreds of thousands, you might even have like an M plus. It when you gotta remember, people's biggest expense is usually taxes. So when you plan with a few 100,000, a lot of that gotta go to taxes. You know what I'm saying? You want to take advantage of these tax advantage accounts that can save you as much money as possible. Like I said, you got withdrawal penalties with the 401k, with the Roth IRA, and you can withdraw how much you contribute, but you can't withdraw your earnings, if I'm not mistaken. So we'll do a whole video on this. And like I said, the 401k has invest limited options. Talked about that. Next, we got brokerages. So you can link your bank account with the brokerage account, and you fund the brokerage account. So for one, you got to select which brokerage account you want to go with. When we talking about Fidelity, Robinhood, Charles Schwab, etc. And you still have to actually invest into something from there, or the money would just sit there. So it's not just okay. I set up a Robinhood account, I get all my information, I link my bank account, and I send the money to the brokerage, and you send the money to the broker, you just let it, you good from there. No, if not, that money will just sit there. You have to actually, from there, pick what you want to invest in. So we're talking about Fidelity, you got Vanguard. I know y'all be seeing the commercials, E-Trade, Charles Schwab, Robinhood. Robinhood, I've heard is very beginner friendly. I be using, I use Fidelity. I like them a lot. They pretty cool. And then study long, study wrong. Like don't with all of these, we just trying to do the main thing, pick a brokerage so we can build wealth for our families. But don't be stuck on like, man, I've been 6 months, I don't know which brokerage. Just pick one. Do a little bit of research. You could, do a little bit of research, but don't be stuck on it forever. Fractional shares. So like I was saying in the beginning, a game changer. You can literally start with $1. So let's say a share of Apple is $200 and you don't want to buy a whole share of Apple. You could buy a fractional share of Apple. So you could buy $20 worth of Apple. You could buy $50 worth of Apple. And that way you could, you know what I'm saying? You might not have it where you want to invest the whole share. You might not have the money at the time. You could buy a fraction of a stock and your dollar amount would appreciate. So if Apple goes up 20% and you put $50 in Apple, your $50 will go up 20%. If this interests you, make sure the brokerage that you select offers fractional shares. Not all shares offer fractional shares. I'm pretty sure Robinhood does. I know for a fact Fidelity does because I use fractional shares as well. So if that's something that interests you, make sure the brokerage account you set up offers fractional shares. No excuses. Like I said, you can start with as little money as you want. So what do I actually invest in? So in the stock market, you got individual stocks, you got index funds, ETFs, you got bonds. Obviously, we talked about individual stocks. These are companies that are publicly traded. So then you also have index funds and ETFs. So these are baskets of stocks. For a beginner, the easiest way is to go with ETF, and ETF stands for exchange traded funds. You can invest in all the companies. So, with starting out, you might do research where you don't really you start researching like, okay, what do I invest in? You know, a lot of people say start with what you already like to consume because you got an idea of that company already. So you might research, well, okay, you got an Apple phone, you start researching Apple. You be on Google every day. You got on Nike shoes. You know, you could literally probably just look around your room and see 50 companies, you know. But I say research into that company because it might be a bad company on the stock market. You know what I'm saying? We in here to make money. We're not trying to just invest and just lose money, you know. But for just starting, most people, beginners, should not even be investing into individual companies. That's where index funds and exchange traded funds come in. They're a basket. So it might, okay, do I invest in Apple, Google? Do I invest in Microsoft? Invest in all of them. You remember we talked about the S&P 500. So the S&P 500 is the 500 largest companies in America by market cap. Remember we talked about market cap, shares outstanding multiplied by the share price. And as far as investing in all of them, you get a small piece of the pie when you look at these ETFs and index funds that track the S&P 500. And index funds and ETFs, they're very similar. They're sort of kind of like index funds like an uncle and ETFs like the nephew. They both track different indexes. And with ETFs, I think they'll help you a little bit better on your taxes, if I'm not mistaken. So some popular ones, we got VOO. This is an ETF that tracks the S&P 500. You got VTI. This is the whole stock market. You got VXUS. This is a bit with international stocks. So you might not want to have all your basket put into American stocks. You might want to put a little bit in international. So for a lot of people just starting, I'm gonna show y'all the Vanguard, the Bogle heads. A lot of people, they would just say, okay, go. You might put 80% of your money in VOO. You might put 20% of your money in VXUS. You know, the percentage that you put into the stocks. Total market ETFs are a much safer investment. Think about it. So if I'm investing to the S&P 500, I'm investing in the VOO, and Apple goes down, it's not that bad compared to if I was just invested strictly into Apple. You know what I'm saying? When you're investing to an individual company, yes, it's potential for a higher return, but it's also a potential for you to lose your money as well compared to ETFs. Yeah, it's a slower, it's a lower return, but it's a safer investment. You got to figure out your risk. And a lot of us, we just been gamblers. We were trying to be builders. We're trying to be investors. You're going to sleep better at night when you're in the ETF compared to individual stocks, we will talk about. And then you also have, I forgot to mention, you also have target date funds as well. So a lot of times your 401ks, they'll have a target date fund. So what that is basically it'll be a allocation of a mix of stocks, bonds, international stocks, small cap mixed together, and they move off of your ideal date of retirement. So how it works is when you're younger, you can invest into a lot more riskier things because you have time to rebound if the market goes down compared to when you're older, you want to invest into a lot more conservative things because when you're near retirement, you don't want your money to be going up and down. You want it to be consistent. So what a target date fund is it that do it for you. So you might have it where you set to retire 2070. Okay, now it's 2026, so it's gonna be investing into a lot more riskier assets that has potential to grow a lot more. So like stocks and different stocks and whatnot. Compared to the older you get, it's gonna start investing into more conservative things. So we got target date funds as well. With when you invest into your ETFs, you want to think about expense ratio. So this is the fee that you're being charged for investing what you're investing into. So think about, okay, let's think about, we talked about the S&P 500. What if you just individually put investing in 500 all 500 of those companies? That's gonna be a lot. So this sort of kind of charge you for investing into the ETF, if that makes sense. And it's sort of kind of like the tax thing. You got to be careful with expense ratios. When they say low cost index funds, low cost ETFs, this is what they're referring to. You don't want to have to be investing in things that's charging 1% and 2% because that adds up over time. I'm gonna show you a visual as well. So this is an example of why your expense ratio is so important. So we talked about VOO. The expense ratio on VOO is 0.03%. So basically, hold on, give me 1 second. if I put $1,000 into VU, at the end of the year, I would pay 30 cents as far as the expense ratio. That's not that much because look at it, 0%, 0%. After 40 years, I've only paid 2% of my investment. That's not bad. But look at when we get into like 2%. After 40 years, 55% of my investment then went to fees. 55, that's over half. So you got to start thinking about stuff like that. So let's look at let's look at it as a visual. If you buy an investment with an annual fee of 2%, you do not touch the investment for 10 years, you lose 18% to annual fees. Damn, that's a lot of money. So I put 10,000 in. I held it for 10 years at a 6% annual rate of return. Paying no fees, you would have $17,908.48. With a 2% annual fee, you would have $14,632. That's an 18% reduction. So let's look at another example. If you buy an investment with an annual fee of 2% and do not touch the investment for 30 years, you lose 45% the annual fees. So take that same 10,000 and hold it for 30 years, 6% return. With no fees, you would have $57,434. That's a good amount. I'm cool. With a 2% annual fee, you would accumulate $31,329. 45% of my money gone. So be careful with your expense ratio, especially when you talking about like your 401k and stuff. Like you don't 0.03, 0.1, but when we talking about stuff like 2-3%, man, but half your money gone, even more. Like look at that, 90 after 100 years. Think about when we talking about real generational wealth, generations down the line. Hopefully we still here by then. But when you talking about your family got money, all that money gone to fees. So be careful with that for sure. So yeah, make sure we paying attention to the expense ratio. And then, like I said, we got individual stocks. So individual stocks have more potential to make more money, but are also a lot more riskier. Just being honest, most people, especially in the beginning, they don't really. A lot of people. This is what I was saying, like information, not necessarily information overload, but you're gonna have contradicting information where you're gonna have to figure out what type of investor you are. So a lot of OGs, a lot of people say don't invest into individual stocks. Some will say, but being honest, most people don't need to be investing in individual stocks for real, because they don't. It's a lot of work required. Obviously, you can make more money, but you got to do a lot of work as far as research. So they you have when you go on vacation, you're gonna do the research as far as what hotel you staying in things. Same with these stocks. Like you put your hard earned money into these companies, you gotta do the research. When we talking about, they call it fundamental analysis, technical analysis. So do you have the time and dedication to constantly be researching this company, whatever you're investing in? Who's the CEO? What direction are they going in? You gotta look at their financials. You having to see, are the competitors, like, so you gotta do this all the time. And most people, be honest, most people don't. And even then, if you do, people still lose. You got people that's on Wall Street doing this 80 hours a week and still getting things wrong. So you got to understand and figure out what type of investor you are. Like I've been learning, like I said, I'm just starting, but I'm learning like, okay, I think I like to be in a low cost index fund ETF and just be more passive. Like if I'm investing into whole market funds like VU and VUS, I don't really got to think too much because it's gonna do what it do. Yes, it's a lower return compared to if I invest in individual stocks, but I'm not losing money for the most part. You know what I'm saying? And then that's the part where it comes with looking at individual stocks, because you're gonna be looking on Instagram and you're gonna fear, FOMO, fear of missing out. You're gonna see he posting 1,000x return, but they never gonna post when they lose. Remember, social media is a highlight reel. Folks not gonna post when they down. Most people not gonna post when they down. You know what I'm saying? For every success story you see on social media, it was 1,000 failures that try the exact same thing. So, just figuring out your own race, figuring out what type of investor you are. Like I said, most people are gonna do is meant to just invest into index funds, low cost index funds and ETFs, not individual companies. And like I said, a lot of the greats like Warren Buffett, that's what they'll say. But you do have a lot of people that you might like, a person like that, they might invest into individual stocks. Even a lot of people say, okay, put most of your money into ETFs and then put no more than 10% to individual stocks, because that way, if that stock go down, it's not really hurt. It's 10% of your money, compared to if all your money is into individual stocks and they go down, you might be through. Then you panicking. You know what I'm saying? So like I said, we try to figure out what type of investor would you like to be. How much money to invest? an amount that allows you to be consistent. With fractional shares, it allows you to invest with as little as $1. So it might be, remember, you looking at your budget. How much do you allocate towards the stock market? It might be, okay, I'm putting 100 a month towards the stock market. It might be, I'm putting $20 every paycheck. Whatever works for you. The main thing is consistency. When we're young, we got plenty of time on our hands. Let's take advantage of our youthfulness. It don't got to be this large boku of money where we put this money and then we just quit. Because once that compound starts kicking in over time, it's gonna be crazy. It's just showing you like a little basic visual. So let's say a person starting at 25 and they're gonna start, I guess, when they're 65, and then you got a 7% return. You invest in 1,000 a month. So the blue is your invested, how much you putting in. Remember we talked about in the beginning that compound interest. So in the beginning, that compound interest ain't really kicking in, but look, towards year 8 and 10, that's when it really starts. That's when it really starts going up. Give me 1 second. Let's see what the thing. Okay, there we go. So let me see. So you got 15 years, you got 180,000 that you've put in, but the compound interest at 316,000. You know what I'm saying? So that's when we start talking about time in the market beats time in the market. So just be consistent and stay consistent. The market gonna do what it do, And over 30 years, you done accumulated $1 million. Yes, it took 30 years, but the time gonna go by anyway. So say 20 years. 20 years, you done got $500,000. You know what I'm saying? So this is a visual showing you, okay, you to put the money in, but look at the compound interest when that money really start working for you. That's when your interest start earning interest. So it don't gotta be the big amount. It might not be where you doing 1,000 monthly. It might be where you putting 200 monthly. Even then, $200 a month is still 100,000 after 20 years. Like that's, you know what I'm saying? Boy, math is really crazy. Find a system that works for you and stay consistent. It doesn't have to be this extravagant amount, especially when we're younger, because we have time. Consistency, compound, consistency. How to invest with the money you put in. So we got dollar cost average and we got lump sum. So the best way to invest, the easiest way, the most not confusing way is to dollar cost average. So basically what that is you set a day or you set a time in the month when you're going to invest. You might say the first of every month I'm gonna invest money into the market. So you might have it where you put 200 a month into the market, or you might have it where every paycheck I'm putting $50 into the market. No matter if the market's up or down, you just dollar cost average in. So what that means is when the market's up, you invest. When the market's down, you invest. When the market go even further down, you still invest. When the market go up, you invest. It don't matter what the market doing, you just keep investing. Remember, consistency. We're not trying to time, okay, when the market drop, because a lot of times you'll see a lot of people say, okay, buy the dip. And that makes a lot of sense because you're buying at a discount, but how do you know when it's gonna dip? You know what I'm saying? It might say buy the dip, but then it goes on another 5-year run and you then missed out on 5 years of gain. So make it as less confusing as possible, just dollar cost average in. And then when it does dip, you could buy even more potentially. You know what I'm saying? So don't overthink it. You also have lump sum investing. So you might come across some money with your taxes, or you might get some inheritance or something, and you just lump sum that investment in. You just put it in. You can even dollar cost average the lump sum. It might be 10,000, where you just put 1,000 in, 1,000 in, 1,000 in every month. So don't overthink it. But like I said, for most people, the easiest way is to dollar cost average. Time in the market beats time in the market. We're not trying to beat the market. We're trying to be the market. So don't be out here trying to be a Warren Buffett, especially in the beginning. Like, just get your experience as far as experience as actually having a couple dollars in, and then keep learning from them. Y'all gotta think about taxes. So when we're looking at we gotta talk about taxes with everything. We're talking about taxes with the retirement accounts, but just a lot of things. Make sure you speak with your tax person, going over everything. Make sure what works for your specific situation. And then what else we gotta talk about? I'm trying to get out of here. If y'all still here, I definitely appreciate you. Talked about that. So yeah. And now just figuring out, watch out for that, books. And then a couple books and YouTube channels. So let's see. YouTube, who do I got? A lot of channels I like. Or, okay, I'll go books first. Boglehead. Boglehead. This book was, this book made it a lot easier for me. So, cause I remember when I first started, which wasn't that long ago, being honest, I invested into Microsoft and Visa. So it was like we was talking about it was money I was willing to lose because remember it's an investment at the end of the day. And it went up, but I didn't really quite know what I was doing. So it was basically me watching a YouTube channel and the person that was saying these are good companies to invest in, and I did it. But I didn't do any research, I didn't do any fundamental analysis, none of that. So you gotta think, is that an approach to have? Just listening to somebody else? Not really. So I had to really go back to the basics and okay, let me do my research. So I found this book, The Bogus Head Guide to Investing, and it made things a lot easier. It wasn't that confusing. And with Bogleheads, they basically sort of kind of follow the John Bogle. So he was the I think he was the founder of Vanguard, and he came up with the index fund. So very, very easy for your average everyday person. We get up, work our jobs. We ain't trying to study the market all day. This is just start here with this book, and it gives you your personal finance in the beginning of like what you should have, ways to be able to invest money, have money saved and things of that nature. Then you start talking about the investments. So with them, they follow a 3-fund portfolio. So remember we talked about VU, that's the S&P 500, or we didn't talk about VTI, but VU is the S&P 500, so 500 are the largest companies in America. VTI is the total stock market, but don't get stuck on it because they're very similar. So whatever one you go with, VU. Then we talked about VXUS, so that's the international stocks. Like you're not putting all your baskets into America, and then they also have bonds. So, but with the bonds, you don't. I ain't saying you don't gotta. Well, let me say this. This is I should have said this in the beginning. This is not investment advice. This is not this is just entertainment, educational purposes only. Please consult your tax advisor. I'm not no professional, like I said, I'm just sharing my story, how I got started, why I got started, and different resources. So I forgot to say that. But you got bonds as well. But when you're a younger person, remember, when you're investing, you gotta figure out your risk tolerance. When you're younger, you can invest into a lot more riskier things because you have time to recover. When you're older and you're near retirement, you want to invest into things that's more conservative, that's not going up and down because you don't want your money just going all over the place when you're about to retire. So with bonds, they're more safer and they're more allocated towards when you retire. But you don't really got to invest in the bonds necessarily when you're as young. But like I said, this book, and they also have a community. So you got the bogleheads.org. Let me see. And like I said, they follow the 3-fund portfolio. Let me find the real website. Bogleheads. My bad, y'all. Bogleheads.org. And you can literally ask them anything. So you new to investing, you would start here. And they'll give you the investment portfolio. I mean the investment philosophy. They got videos on investing. So yeah, it's pretty easy. It's pretty for like the everyday person like me and you. You know what I'm saying? Just you want to get started in the stock market, you can start here. So we want the Bogleheads. Let me see who else we're gonna talk about. Who else I like? Go through some YouTube channels. I'm just referring to the stock market. I like Clear Value, wherever he is. Asian dude, Clear Value Tax. He not no fluff. He usually talks about the he talks about the economy, what's going on with that. He also has stock market, but basically I go to the playlist where you at stock market for beginners. Start there, pretty easy. Who else I like? Um, Earn Your Leisure, they pretty cool. They got a stock show for beginners. Well, not a lot. Sometimes they get really advanced on there with the options trading, but it's still cool. They come on. They got Market Mondays come on every day. My bad, y'all. This is kind of freestyling. Am I subscribed to him? You got Chris Sane. He pretty cool. He got a cool little channel. Hold up, y'all. You got Marco Whiteboard Finance. He's pretty cool. I go to the playlist. He talks about a lot about personal finance, Bitcoin, stock market investing. I would start there. He also has a Whiteboard Finance University. That's $10 a month. I'm in there actually, but it's pretty cool. Like, yeah, you know, you just like I said, it's $10 a month. It ain't that crazy, but in there he got a couple courses. He also has where you can ask him literally like personal questions. They'll get back with you in there. So if you have personal questions as far as starting, you know, you could get into you can get into his little online community. Like I said, it's $10 a month. I've been watching him for like 5 years. He pretty cool. Let me see a couple more. You had a personal finance club. It's a dude I came across a couple years ago. I just started watching the podcast. He's pretty cool, but he's what I be talking about. He's a pure index fund investor. Like he um he don't really invest. He just want to tell you don't invest into individual stocks. But he has a pretty cool podcast for beginners. Wall Street Trapper. He pretty cool. You know, I usually just start with the playlist. The Finance Rebel. Let me go with them. Let me show these real quick and then I'll get y'all out of here. If y'all made it this far, bro, I appreciate it for sure. The Black Wealth Rebels, they got a Patreon. They got a YouTube where they talk for free. But the reason I'm talking about the Patreon is because the Patreon they just pay $20 a month. But in it they got a lot of courses. Like I said, just 20 a month. Um got a Bitcoin podcast teaching how the options. But I was going, they got an intro to the stock market course and they got you like a fundamental analysis course, like how to evaluate individual stocks. But they got way more. So you got precious metal course, you got real estate valuation, you got all types of courses. But $20 a month, you can't really beat it. And I think I'm gonna show you one more. So then you know you got different things like Yahoo Finance, CNBC, just really getting familiar with the information and then just jumping in, getting started. You don't gotta you start with money that you know a little bit of money and then just get rolling from there. Remember, it might be okay instead of listening to music while I'm going to work. I might listen to a podcast about you know what I'm saying, getting on this. I might listen to an audio book. Remember, I showed y'all that book. Yeah, man, it's basically just getting started. Like I said, I hope I ain't make it confusing, but just trying to show how to get started. I think we talked about everything, and we'll make smaller videos into this on like different things like the retirement accounts and you know things of that nature. But I think that's everything. If y'all have any questions, please reach out. If you made it this far, I truly appreciate y'all. If y'all could like, comment, subscribe. If you is liking it, please tell a friend. But thank y'all so much. Stay blessed.